Good morning, I'm Raymond Yeung. How to reduce tax legally. I must stress that you must do it legally in accordance with the law. You cannot contravene the law or break the law. If you commit an offense in tax law, you may be liable to penalty action. The penalty action may be a prosecution from IRD. It may be a fine 3 times the tax undercharged. So be careful when you do tax reduction. I suggest you do it very carefully, and if you in doubt, if you have questions, if you are not very sure whether it is legal or not to do it, seek professional advice from accountants, from lawyers, from tax advisors, from me, of course. To reduce profit tax, of course, this is the dream of many business owners. The most common way to do it is to pay the director, the owner, the director fee or director salaries. If the payment, the amount of the payment is reasonable, the IRD will allow the deduction of the director fee and the profit tax of the company. That means the company's profits will be reduced as a result of the payment of the director fee or director salaries. On the other hand, the director may need to pay salary tax on such income, but director may claim personal allowances, may claim home loan interest deduction, may claim self-education expenses. He may claim exemption, for if he visit Hong Kong, in that year assessment not exceeding 60 days, he can ask for an exemption, for that part of salaries, For director fee, IRD will not allow, exemption for visiting Hong Kong not exceeding 60 days. So be careful. You must, when you have a distinction between payment of director fee and director salaries, and make use of the personal allowances, etc., to reduce the tax, the salary tax liability of directors. And of course, the company may also, provide benefits, non-cash benefits to the director. For example, free accommodation, provide a car for the director to use. The car is registered in the name of the company, and the company pay for the expenses of the car, and the director use it because it is a non-cash benefit. That benefit cannot be converted into cash, cannot be sold to other parties. In that case, such benefit is not taxable. But on the part of the company, it is an employee benefit, is deductible expenditure. So the company can reduce the profit chargeable to tax. Apart from doing that, the company may reduce its property tax liability by postponement of the sales. For example, if for the sales in near the accounting day, near, for example, if the company closes accounts on 1st March, then the company may consider postpone the issue of invoice for those sales in March to April. In that case, the sales of the company, the profits from the sales will not be assessed in the current year, and it will be postponed to the following year. In that case, the company profits will be reduced. But of course, audit may challenge it. If for example, the goods are delivered, if the money received and from the sales, then you cannot postpone sales. Because the sales have already effected before the accounting day. Another way to reduce tax is to write off the obsolete stock. To adjust the valuation of the closing stock. For those outdated stock, obsolete stock, slow-moving stock, the value should be reduced. Because they cannot, have the market value. Maybe cannot be sold out, maybe so scrapped. So review the closing stock to see if any reduction, of the valuation is possible. Of course, you must do it, with reasonable grounds. You cannot arbitrarily reduce it, without grounds. I'll be checked, find that you, reduce the valuation of the closing stock without good reasons. They may impose a penalty on you, charge you back the understated profits, charge tax on that. Another way is to, of course, the debtor, bad debts. The debtor, debtors do not pay their debts. You may consider, write off such debts as bad debts, as expenses, in the profit and loss account, so as to reduce the profits. Under the IR ordinance, bad debts are deductible expenditure. But be careful. Audit may challenge you writing off such debts. You must have reasons. So the common reason, good reason, is that you take recovery action, against such debtors. That means you may send out reminders, just send a letter to them before the accounting day. Then if they don't respond to your letter, don't pay, give them a notice, then you write off the debt as bad debt, and the audit will usually accept it because you have produced evidence and you have made effort to recover the debt, and you cannot get the money, so you write the debt off. That is reasonable, and by doing this you may reduce your profits. Another method commonly used is make commitment or make purchase of equipment or expenditure before the accounting year end. For example, you have an advertising campaign, for example, in April, then do it in March. So reduce the tax, and because there is an expenditure. If you want to purchase plant and machinery in May or June, then why not do it, in March? because when you purchase the equipment in March, you can get depreciation allowances. It will reduce your tax liability. In Hong Kong, depreciation allowance may be very substantial because the depreciation allowance rate is high, 60% for the initial allowance, and the balance, put in a pool, and then you can get maybe 30% if it is a motor vehicle. Another way, to reduce tax is payment of management fee, consulting fee to related companies. But if the payment is the amount is big, how they may challenge it. In law, if the expenditure is incurred in production profits, it will be tax deductible. The burden of proof is on the taxpayer. So Audi will ask how the consulting fee is computed, how the basis on which the amount is determined, to see if there's no good basis. They may say that this is tax avoidance tactic, this is just do it for getting a tax benefit. They may disallow it. You cannot get deduction for such expenditure if IOD thinks that no good reason for payment of such big amounts, because so the IOD will examine the breakdown of the cost incurred by the related company, who provide service to the company. So you must, prepare a computation basis, before you do this, before you pay, your related company money to reduce your own profits. Be careful, if the IOD disallow, the expenditure of your company, that doesn't mean that the income, the money received by your related company, the sales, the revenue, the income, etc., can be reduced accordingly. There's no such thing in tax law. So be careful when you do it. Also, something you may consider to do to reduce tax liability. For example, review the financing, the interest payment. In some cases, IOD may not allow interest deduction, because the company, because the conditions under the IRO cannot be satisfied. Particularly, if the company pays interest to a related party, for example, a director or a holding company, some party connected with the company, then the ILD may examine the reason, the use of the loan, etc. If the person, the party receiving the interest does not pay tax on such income, such interest income, then the company may not get deduction and the profit tax for such interest payment. So be careful. Another point is that if the company borrows money, then of course from a bank, usually the interest payment can be deductible. But if the money is borrowed by a related company and then let it to the company, then such interest payment will not generally be deductible, because the borrower of the money from the bank is the related company, not the company. So Audi will say that this the section 16 bracket 2 cannot satisfy it. And when you pay interest to the related company, because it is not a bank, because it is also not deductible, so be careful when you do this financing arrangements. You may also consider a review of your offshore operations or offshore income exemption. For example, if you have gains for sales of property, sale of shares, share dealing outside Hong Kong, such gains should not be taxable, and you should exclude it in your tax computation, because they are offshore. Because for example, a share dealing overseas stock market offshore, the gain is not taxable under Hong Kong tax law. You should also review the accounting procedure, accounting treatment of capital and revenue expenditure, or capital and revenue receipts. Where if you do it wrongly, Audi may adjust your profit and then impose a penalty against your company. That may increase your tax burden.